Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Today, we're going to discuss how you can secure your first $150,000 without documentation or without any financial review using these secret strategies in 2025. If you are new to this channel and you have not been subscribed before, please drop a comment below, drop it and say new or new viewer, anything like that. I would like to welcome you personally to the channel, and I do appreciate you watching and giving me the time. So I would definitely want to provide you the most value possible. Now, from the beginning of January 2024 to May of 2025, I've gone on to secure credit cards and other business funding with over $500,000 in working capital. And I did this starting with bad credit with a $200 secured card to where we are now. I'm not a coach or mentor or financial guru or anything like that. I'm just a regular guy who's documented this process with discipline, self-education, and determination. And if I can do it, I know that you can do it as well. All the information I provide on this channel is 100% completely free, and I have over 300 plus videos on business strategies, tips, inspirational and motivational content. So if you are brand new to business credit and have no idea what this is, I have a playlist below that you can use to get started. I would watch this video first, but after that, if you have not started a business, I suggest going there and watching my updated video on how to start a business. I also have another video on how to structure your business after you start it. And structuring is really just a way of saying that you're getting this business ready to be funded. And as I go through this, I'm going to talk about it as if the prerequisites have already been met in order to qualify for funding and also use this strategy. But as I'm going through the video, I'm going to be sharing personal experiences with myself, other resources that you can use that will also be free as well, and different ways that I think this can benefit you, as well as some information to help guide you so you know exactly what you're doing with this capital without it being something that can be detrimental to you overall. So without further ado, let's get right into the video. Now, like I said before, the way that we're going to be discussing this is as if you already have a business and you meet the prerequisites in order to qualify for these products and to implement this strategy. So now that we're going forward with that mindset, let's talk about what credit card stacking is again. Now, most people have a general idea what credit card stacking is, and a simple explanation is applying for and being approved for several different credit cards. In this instance, we're talking about business credit cards. The reason why we're talking about business credit cards is because a majority of them do not show up on your personal credit, so they will not affect your personal credit score if you use them. However, when you stack credit cards, you want to do this in a specific order to access larger unsecured lines of credit than individual small business credit cards could offer you. And again, I'm going to explain how that works, and we'll also talk about the cost and the benefits and when this may or may not be a good idea for a small business owner. But for most people who are using this strategy, we're going to be doing this in the hopes that we already have a business plan, we already have a proof of concept, and we already have a general idea about how to effectively use this business funding. And if you have no idea what you plan on using this funding for, then I don't think that you should be focusing on this right now. You should be looking at starting a business and creating a business plan. So let's talk about how credit card stacking actually works. First, you want to review your personal credit scores. You do have to personally guarantee everything. And if you have bad credit, I would still continue watching this video. I have a personal credit repair playlist that's also in the description. Highly recommend that you check that out. Usually anything that's on your credit, you will find in one of those videos, and they should be able to help you. Again, whatever I talk about, there will be a free resource that you have access to that you can take a look at. But no matter what you're trying to do, when it comes to credit card stacking or business funding sequencing, you cannot avoid personally guaranteeing these credit cards or these lines of credit or anything, these loans. You will have to personally guarantee. So before you can start credit card stacking, you'll need to review your personal credit score, your income, and other relevant qualifications to identify that you will qualify for the different products that you are trying to get. I do a lot of research on credit cards, and throughout my time with getting business credit cards and business credit funding, I have documented each process. I provided data points so you can reasonably access each one of these cards or each one of these lines of credits or even these loans, any of the ones that I speak about, I've been approved for and I've made a video for with the data points of what it took to get approved. So you can rest assured that you'll know each and every one of these accounts and how you can get approved for them as well. As a general rule of thumb though, your credit score typically needs to be at least, I would say 680 or above. Now, in other cases, I've seen people that have really thick credit profiles with extensive history with even low scores like the 650 range, and they can still get approved too. But generally, I would say 680 or above is what you need to get qualified for almost all of these business credit cards, lines of credit, and any business loans. It's also worth noting that it's not guaranteed that you'll be approved just because you have a high credit score. What's more important than your credit score more than anything else is actually your credit profile. Believe it or not, you can have an 800 credit score that's thin and you may get denied for a lot. That's not just business credit cards, that's personal loans, that's mostly everything. Your profile is probably more important than your overall score. And I can give you an example. I had a 700 credit score and I had one charge off that was remaining on my credit. And this was last year at the beginning of January when I just started this YouTube channel and I wanted to test out applying for a few things. I did some soft inquiries. I did some hard. I did not get approved. So even if you have a high credit score, let's say one derogatory mark, that can prevent you from getting approved. And even when I had a 750 credit score, but my credit profile was still thin, I still got denied for a lot of things because I didn't have the length of credit and I had small accounts with small balances. So again, we'll talk about different ways that you can strategize around this, but ideally you have at least a credit profile with a 680 or above with maybe 2 revolving accounts, maybe 2 installments for a good credit mix, and at least I would say 2 years of credit history. If you have 1 year, that's fine. I had that same thing, but I think 2 years is like a really good sweet spot if you had an average of 2 years. Now, once you have reviewed your credit profile, you know where you stand, and you kind of have an idea of what you can qualify for, you'll want to look for cards with 0% APR. So this means for a certain period of time, usually 6 to 18 months, you don't have to pay interest. Now, why is this important? Well, if I want to make a large purchase for something, let's say like inventory for my business, then I don't want to actually have to pay for that inventory up front, especially if that inventory is going to make me money down the line. What would be best for me as a business owner is having the ability to put that inventory on a business credit card where I can then pay, let's say, the minimum payment for a certain period of time. And as I'm selling that inventory or making money from whatever I spent on my business, I can then pay back the money that I owe while also keeping my profit. So that's a way that I can maximize my potential profit by leveraging credit and also using 0% APR. Now, the next thing that I would do, because again, this is a strategy, we're looking for ways that we can maximize and leverage credit. So not only will I look for 0% APR credit cards with, of course, high limits, I'm also going to be looking for cards with rewards and spending bonuses. So let's say your business industry requires you to purchase software. There are certain credit cards that will give you 4-5% cash back for particular transactions or a combination of things. Or if you hit a particular spend bonus, maybe they'll give you $500, $800, $1,000 back for hitting that spend bonus. I recommend looking for cards that can do both. 1, 0% APR. And secondly, they have rewards where when you spend, you make money, or they have spending bonuses where if you spend this amount, you can get some money back. That way, everything that you're doing is somehow making you money or giving you some sort of advantage. And that's what you're looking for when you're looking at potential credit cards. And this will be different for everyone. It depends on your business and how you're looking to make money. Now, I recommend choosing between 5 to 10 business credit cards, and you don't have to get these all at one time. You can split them up into rounds. Maybe one round I get 4, another round I get 4. This next round, maybe I get 2 or I get 3. I'm not saying get 10 at one time unless you just wanted to. I recommend spreading them out so you can maximize each 0% APR offer. And again, the reason why when you do this, you want to start a business, I'm sure there are some people who are thinking, well, if I have good personal credit, wouldn't I be able to leverage my personal credit and do the same thing? Well, yes, you can, but you have to remember, one of the biggest parts of your credit score is utilization. That is 30% of your overall score. So let's say that you had a $10,000 credit card and you want to spend $9,000 on inventory for your business. That would make your utilization on that card 90%. That would effectively tank your personal credit score. If you had a 750 score, you might drop to like a 670 by doing that. And it would also make it to where if you apply for other cards, you probably would get denied. You want to get business credit cards because, again, they don't show up on your personal credit normally. There are some that do, but the ones that we will discuss today will not. So you really want to be strategic and intentional when you're doing this. So as long as you are making the payments on time, you don't have to worry about this actually showing up on your personal credit score. Now, if you default on any of these cards, it will report to your personal credit. So this is a risk and you want to be careful. But if you took the time to vet your business, you have a good idea, and you're using good risk management, then this should not be an issue for you. We're going to be more focused on how to be successful and not be fearful in our business dealings, because even if we were to fail, there should be a contingency plan in place so that even if we fail, we can try again next time. I want to talk about the benefits of credit card stacking. So we discussed some benefits here, but I wanted to share personally with you how this has benefited me. So if you're an entrepreneur and you want to start a business, for a majority of business owners, you need to spend money in order to make money. So I have old videos where I talked about saving my first $15,000 in a year on a low income, and what I was doing, like high yield savings accounts and other things like that, to try and maximize interest and just grow my money more effectively. My goal was to save $100,000. And at the time I struggled. It was very, very difficult. But there was someone who introduced me to business credit, and he was a coworker at my last job. And I remember when I first started, he just came in there one day and was like, I just got $30,000. And I'm thinking, got $30,000? How did you get that? So he's telling me how he started his business and he was applying for all of these business credit cards, and he just secured $30,000. And at the time, I had no idea what that was. I thought that was complicated, like it was hard to get loans for your business. And that was my interpretation of what he was doing, because I had no idea. And you have to pay back loans. Interest rates are high. Like, I'm not touching that stuff. That sounds like a horrible idea. But he came into work a couple weeks later and he said he got another $30,000. So I was like, man, in the span of like 2.5 months, this guy has gotten 30,000 again, 40. So he had gotten like $100,000 in capital, and he did that in like, I want to say like 3 or 4 months. And I was struggling so hard to save. And at the time, a light bulb went off in my head, and I was like, oh, okay, if time is currency and time is inherently worth more than money, if it takes me 5 years of my life to save this money up, then it makes more sense for me to leverage credit. If I can get approved for 60, 100, 150K, is much easier when you're leveraging your personal credit than it is to save $100,000, $150,000. That's a lot harder to actually do. Not to mention, in 7 years, if you had bad credit, most things would fall off anyway. So, I mean, the way I saw it, I might as well work on my credit, get it better. Worst case, in 7 years, I would at least be in position to be able to do what I want. One thing I do want to point out, because while the benefits of credit is great, there's also a lot of cons, right? I haven't really used it as much as you would think, because I learned that having a cash flowing business that actually provides people with value and solves a problem is way more valuable than leveraging your personal credit. And that's the truth. A lot of people try to use credit card stacking like an additive, like if this was sports, sometimes people use leveraging credit like the steroid in order to, become something greater than what you actually should be. You're not actually putting in the work. Like, you didn't go to the gym and practice 1,000 times, or you really weren't putting in as much work as you should have, or you try to take a shortcut. This is the sequence that I recommend that you use when it comes to having a business. Number one, you want to start a business, right? And then you want to have that business start to make money. You want to get good at that business. The next thing that you want to do is then get credit and leverage credit and secure $150,000 in business funding. Because if you were able to make money from your business and turn zero into $100, what do you think's going to happen when you have, let's say, $1,000? You're going to turn that into 10,000. Then you'll turn that 10,000 into 100. Then you'll turn that 100,000 into a million by leveraging credit. But the only reason why you were able to do that is because you got really good at that business or that thing from zero. You have to learn how to make money before you start leveraging money. So if you don't know how to make money or you've never done whatever you're planning, my recommendation is to slow down. Get good first, leverage credit later. That's just my advice. You don't have to take it. It's just I'm letting you know personally what I've been through and what I've learned. Now, here is a visual representation of what credit card stacking can actually look like. I separated this by bureau. That was intentional because a majority of business credit cards and business funding, lines of credit and loans, they pull your Experian credit score. So I just want to make note that Experian is a very, very important bureau. And let's say you're in the process of repairing your credit right now. If I had to choose one to focus on, it's not like I'm saying you should focus on one more than the other, but let's say that for Experian, you had like one more derogatory mark. I would kind of put more time into getting that one derogatory mark off of Experian because you can get a lot done with just that bureau. And then TransUnion would be the one that I would say is the second most important. And the last one that doesn't get pulled as much, but you does still get pulled for a few different banks is Equifax. But remember, as you're looking at these limits, and this is just, again, a very simple a visual representation of what we're trying to do. Keep in mind that your credit profile is still more important than your credit score. The reason why I'm saying this is because banks use specific algorithms that dictate how risk is assessed. You want to look at your credit profile as a transcript or a report card. You need to have primary credit lines that have high limits. So here's what I'm trying to say. If you think that you're going to get a $12,500 business cash card from Chase and all you have is a $500 credit builder account on your credit profile, even with the 750 credit score, it's very unlikely that you're going to get that $12,500 limit unless you have other primary trade lines, primary credit cards, which means you're not an authorized user on it. Unless you have primary accounts that have similar limits, it's unlikely that you'll get that credit line. I will give you other strategies that if you don't have those high limits that you can use. But I just want to say, like, at first, if you're looking at this, that's one thing that I would definitely advise you to take note of. Too many consumer-based credit cards like credit builders or store cards where you can only use that card in a certain store, they don't necessarily help your approval odds. Everything has a purpose. Credit builders are great for rebuilding when you have bad credit. After your credit has been repaired, the thing that you need to focus on is getting primary trade lines, primary credit card accounts and loans from national banks, from large institutions. You want to get those and then you want to grow them, meaning graduate your credit line if you had a secured card, getting higher credit limit increases, things like that. That would be a very big focus for a lot of people if they don't have that as of right now. So just keep in mind that banks will lend to you based off of what they can see on your credit reports. So if you have a $500 credit card, even with that 750, your odds of getting approved for a business credit card with a $1,000 to $2,000 limit is a lot more likely than you getting one with, let's say, $12,500. But with that being said, all of the cards that you're seeing right now, they do pull from each of the corresponding bureaus. And I use these specific cards because for the most part, there is an overwhelming amount of data and data points that I have that would coincide with what we're seeing here. Now, again, this is just I'm giving you an example that is actually kind of not that good. Because for some of these, if you got a $25,000 limit and you did it strategically, you could get 4 of these cards and get access to $100,000, or get 6 of these cards and get access to $150,000. But let's say that you got 2 of these Chase cards, the Wells Fargo Signify card, this Amex, this PNC, they all pull from Experian, and you got $12,500 limits, which is actually kind of feasible. I could see that happening for almost anybody. And then you went and did TransUnion, got these exact same cards here: US Bank, BMO Harris, Bank of America, Barclays, Wyndham Card, Associated Bank, and you got $12,500 on each of these. And then you also went to Equifax, and I just did 2 cards because I know I have to put myself in the picture, so I needed some room. I could have put some more, but I'll talk about other cards. But for Equifax and Truist, it's $12,500 each. That would give you access to $150,000, with the majority of these being 0% APR. A few of them aren't, but I think it's only actually one on this list that doesn't have 0% APR, and that's the Wyndham one. The rest of them do. So there you go. That would be a different way that you can get cards from each corresponding bureau, and you can actually get access to $150,000. And again, this is a situation that isn't even ideal. This is kind of like you got a lot of cards with low limits, but you still were able to achieve the same result. In the past, when a lot of people did credit card stacking, they would try to strategically go to each one of these credit bureaus and get these cards. If you've watched my channel, you know I have a video on removing hard inquiries. So here's the great thing about this. If you apply for any of these cards and you did not get approved, you can wipe the hard inquiry, you'll get an adverse letter in the mail, and you'll find out why you didn't get it. Whatever that reason is, you can fix that, and you can try as many times as you want. And that's for every one of these bureaus. So even if you did not get approved, you can wipe the hard inquiry, find out the reason why, and try again as many times as you would like. And the reason why you can wipe the hard inquiry is because these credit cards don't show up on your personal credit. If they did show up on your personal credit, do not remove the hard inquiry. You want to keep it. If they don't show up on your personal credit, then it's completely fine to remove them. I have a credit card hard pull guide. Now, with this guide, it gives you access to over 100 plus banks and credit unions, and it tells you where they pull from. So I gave some other examples here, like Experian, Navy Fed, Go Biz, American Express, PNC Chase, Experian, Bank of America. We mentioned that. Fifth Third Bank is another one. Equifax, the Citi AA Advantage, you have Truist, you have KeyBank. Those are some other ones with business credit cards that will pull from Equifax. And some of these do like double pulls. So for example, with the Citi AA Advantage, I noticed, hey, depending on where you live at, some pull from Equifax, some pull from Experian. Usually it's never TransUnion, but it's Equifax or Experian. There are some that have geo-restrictive pulls where, depending on where you live at, they pull from other bureaus. So it's a really good idea for you to check out this guide. You can download it. It's completely free. I also want to note that some banks are inquiry sensitive. For example, Chase is inquiry sensitive. Amex is not. Maybe you want to start with Chase first and then go to American Express and then work your way down. And again, you can remove hard inquiries as needed. But normally when you apply for something, you get the hard inquiry at the exact same time. Like you'll see it on your report. Some people like to apply online and open multiple windows and apply at the same time. I'm not sure if that actually works. What I would do is apply for one, get approved, then apply for one that pulls from TransUnion, get approved, then apply for one that pulls from Equifax, you're approved, and then wipe the hard inquiry. Usually it takes a week. Sometimes it could be longer now. It could be 10 days. But once the inquiry is wiped, then you can go through and apply for the next 3. If you do this strategically, like I said, 25,000 from 6 cards would get you 150,000. You can feasibly do that in 2 weeks. And then I do want to spend just a little bit more time on the risk of credit card stacking, because when it comes to this and leveraging debt, no matter how much research that you do, no matter how much you believe in your business, things just happen, okay? And you can't control them. What you can control is your risk tolerance, but you can't control everything that goes on around you. There's always a risk when you take on, let's say, $150,000 worth of credit line. One of them is that you can't pay it back if you're not successful. And I got into some serious debt myself. That put me in a bad place, and it took me a long time to repair my credit. So when I'm saying this, I'm not saying this from a place where I've never been in that position. I'm telling you that I've been there, and I'm telling you why I got there, and I'm saying I don't want you to go through the same thing. Sometimes some of us just have to learn lessons. That's just how life works, and that's okay too. But if I can avoid that for a few of you, I would just say now, be as responsible as you possibly can, because why would you want to take all the time to get into this great position and then you're going to be pulled back into the place that you started, and it'll set you back for many years. Really, it took me like 12 or 13 months, but I've had this channel for probably about 15, 16 months. I've gotten access to over $500,000, I would say, in credit cards, business lines of credit, and loans. And the only thing that I've ever used it for was during Black Friday to purchase inventory for Amazon FBA. I documented that on this channel, and I showed you guys how I tried to make $120,000. Did not work out that way, but I did make $30,000 in profit. So you guys got to see firsthand how when you do this, things don't work out, things come up. It may not work, as well as you thought. And everything else that I do as far as business goes, I have a new video that I made a few days ago about all of my different streams of income and how I made 7 new streams of passive income in the last 9 months. In that video, I talk about how all the different streams of income that I make, I never had to leverage credit to get any of those streams of income. And that's kind of my point, is that there's a time where you do this and you can secure all this funding and you can make money, but it normally comes after you've already made enough money from a business to pay this back. I have to say that because again, I'm saying it from experience, and I know how excited people can get when it comes to just having access to capital, but not really handling it properly. Because a lot of times things go wrong way more than they go right. I promise. More times than not, things will go wrong than they go right. So just always keep that in mind. Now, I want to acknowledge something. I know that for some people, depending on your business, some of you do need capital to start your business. I understand that 1000%. New business owners that don't qualify for traditional small business loans or business lines of credit or working capital, they may benefit from credit card stacking or credit stacking. Additionally, small companies or low revenue businesses that have yet to accumulate assets and they're unable to qualify for a traditional business loan may also want to consider this option, because it can be a good way for you to make money quickly, and you can usually get approved and receive credit cards within 7 to 10 business days. Just always have a business plan in mind before using this option. But in those types of situations, I would say that it can be good for you, but always try to make the money yourself first. So before we get into the business funding sequencing, and then I'm going to give you the strategy that you can use, I will be going over credit requirements for most of these credit cards, again, that we talked about, but I'm going to give it more depth. One of my pet peeves: never walk into a financial institution and say no docs. Instead, you want to say, what are the requirements for approval? The reason why I'm saying that is because no doc is a buzzword that's just used on social media. For YouTube, it comes up in search engine optimization because people are looking for that particular thing. No doc, meaning my business makes no money. You want to get 150 grand without having to show that you can actually make money to pay it back. So that's why it is such a big thing. And I get it. I understand. But the issue with that is that when you say that, especially if you walk into a bank, I've worked in banks, I would look at that and I'm going to raise my eyebrow. Don't use terms like that. It's going to hurt your chances of getting any approvals. And some of these, you are required to go into a bank and sometimes apply for these products. Now, for the credit requirements, I would say on all 3 bureaus, no matter which one you're looking at, you want to have a 5% or less credit utilization, meaning whatever your credit limit is, you want to pay it down to where you're only using 5% of that overall limit. And you want to do that before you apply. So if you have 10%, 30, because I know in the comments, some people are going to ask me, well, what if I have this? What if I have that? You can still apply with that. But what I'm going to just say is you don't really have to ask me that. I'm just telling you what's the best position you could be in. If you have 30%, you can still apply. It's just not the best position. If I'm going to do something, if you were planning on doing something, would you want to know what is going to give you the best outcome? I'm just giving you what's going to give you the absolute best outcome for the result that you would like to achieve. So if you have 20%, 30%, yes, you can still apply and you may even get approved. It doesn't give you the best position. All right. So you want to be in 5% or less for your credit utilization, 100% payments on time, no late payments, no late payments. That's an absolute. You cannot have late payments, 0 derogatory marks, 0 collections, None of them. You want to have 3 to 4 years or more of credit history. I will say this. If you don't have 3 to 4 years of credit history, that is okay. There are ways to get around that. One of them, you can just let your account age naturally. The second thing is authorized user trade lines. Those are good for, I want to make this very clear. Authorized user trade lines are only good for temporarily boosting your credit score and for getting auto loans, like if you have bad credit, and they're also good for increasing your overall account age. That will not help you qualify if you have low limit credit cards. It's only good for temporarily extending your age, temporarily boosting your score for the purpose of getting an auto loan. Some mortgages don't consider it. A lot of credit cards, FICO scoring models don't even look at authorized user trade lines when you're trying to apply for a credit card product or a loan product of any sort. Not all of them do, but a lot of them do. And that's why I'm saying the authorized user thing only works for, in my opinion, in 2 instances. So you can use it to temporarily extend your credit history, but that doesn't make up for you having a lack of primary trade lines and low credit limits. You want to have 10 positive accounts, and that's going to be a mix of revolving and installment loans, meaning you want to have some personal loans and you may want to have, let's say, a couple of good credit cards. I would say just even having 2 or 3 good credit cards will do it. Some that have like, let's say $10,000, $15,000, $20,000 for the limit. Once again, if you don't have that, it's okay. I'll give you some strategies that you can use next in order to work around that. And I would say 2 or less hard inquiries. Once again, we have videos on how to remove hard inquiries. Check those out. Don't remove hard inquiries for accounts that you want to keep. So if you have a personal loan and there's a hard inquiry on your credit report for that personal loan, don't remove that hard inquiry. Reason being, sometimes it affects the reporting. And if you have a personal loan that's for $25,000, that's helping your credit score. And if you've been paying on that personal loan for, let's say, 2 years, that's helping your account age. If you dispute that hard inquiry and the account ends up getting removed as well, it's going to hurt you a lot. So leave it alone. But you can remove hard inquiries for business credit cards because they don't show up on your personal credit. I also want to mention before we talk about the funding sequence, based on the funding exposure you want to get, you may be required to provide low documentation. When I say low documentation, I'm meaning like 90 days or 6 months of bank statements. Once again, I'll give you a few strategies, but there was like, for example, SBA loans. I got approved for a few SBA loans. When I got approved for those, they didn't ask me for tax returns, but they did ask, can we see your bank statements for the last 90 days? We want to see how much money you've had in your account. I knew I had a good amount of money sitting in my account. I showed it. I got approved. That's low documentation requirements. Now, full documentation requirements would be 1 to 2 years of tax returns, profit and loss statements, things like that. You normally don't get asked for that unless you're trying to get funding upwards of, let's say, 25 to 50,000, let's say business line of credit and big things like that. When you're trying to get access to like 50, 80, $100,000 all from one particular product, just know that it's expected that you're going to have to provide some full documentation for that, and maybe collateral, maybe even something to where you could back it up, like an asset, something that can easily be liquidated that you can put up. So know that that is something that you can be required to do. That's the reason why people credit card stack or do business funding sequences, so they can get smaller amounts and put them on top of each other to equal a larger amount, because there are way more requirements to get 150,000 at one time than it is to get 25,000 from 6 different places, if that makes sense. In relationship building, for each one of these places, you want to open up a business bank account and a business savings account. You want to have reoccurring deposits and you want to fund these accounts, and you want to do this for 60 to 90 days to maximize funding. This isn't always necessary. For example, American Express can provide you with a high limit without the need of opening a business checking account. But here's the reason why you do this. Let's say that you have a very thin credit profile, but you want to get access to high limit credit cards. You want to, let's say, take $20,000 and maybe deposit like, let's say, $2,500 a week. I don't know, something like that. I'm just throwing out numbers. The reason you're doing that is because it looks like your business is cash flowing. You have an account that just has $0 in it. You open up an account and you want to apply for a credit card with me. I might give it to you even if you don't have any money in my account, or if you put like, let's say $500, very small amounts. If you have a credit profile where I can see that you have $25,000 limit personal credit cards, you have long credit history, all that other stuff, yes, I probably will give it to you based off of what I've seen that you've gotten. But if you want to just do a little bit more, open up the account and fund it, because now it's showing business profitability. I'm seeing this. After 90 days, banks have a snapshot of what it looks like you're going to do. That's how they build a profile on you, all right? By doing that. Another thing I want to mention that no one really talks about is that you want to really look at, let's say, the report on a lot of these banks. Banks have credit ratings assigned to them like Moody's, Standard & Poor's, and Fitch, and these ratings reflect a bank's financial health, risk management, and practices, and their market positions. Credit ratings also help investors assess the risk associated with the investing in a bank's debt and other securities. A higher rating on a bank indicates a lower risk of defaults. So what does that mean for you? Well, banks pull your credit to assess risk, right? You can actually pull the credit rating to assess the risk of the bank. If you know that the deposit relationship with this bank is improving, meaning more people are depositing money, then that means that the bank is more than likely to give you higher credit limits and lend you more money. Now, if the bank is decreasing their deposits over the past few months, you can determine that this bank may not be the best place to maximize funding. So if you look at the rating at the time, you may say, man, Chase is having less deposits in the last 6 months than usual. Maybe I should go to Wells Fargo. Their rating is increasing. You want to know that because sometimes you may not get as high of limits simply because the bank themselves is not having as many deposits. Now, this is called fractional reserve lending. Some of you may have heard of that. Some of you may have not, but it's a banking practice where the bank keeps a portion of their deposits as a reserve and they lend out the remaining portion. This actually allows banks to create new money in the economy as the loan amount is later deposited and can be used again. I know that sounds complicated, but I'm going to give you an example. Let's say that I were to leave $1,000 in the bank. The bank only keeps a fraction of that money on hand. They actually don't have it in the bank if I go back to get that money. So let's say that the bank kept $200 in their reserve. Let's say they put that in their pocket. They're going to lend the rest of that money, which means someone else is going to come into the bank, ask for a loan, and the bank will give them $800. Now, when they give the person $800, the bank is going to say they have $1,800 in their ledger. Isn't that weird? You can't say you have $1,800 if I gave you $1,000, you kept $200, and then you lent $800. So now you're saying that person's going to pay you back. So you have $1,800. That's the banking system that's in the United States, which is weird because they'll tell you that at any time you can withdraw your money. But if we all were to go to the bank to get our money at the same time, the bank would crash. It wouldn't be there. The reason I'm saying all of this is because when you understand how the banking system works, you can take advantage of getting maximum funding based off of how well a bank is doing. The same way they pull your credit report, you need to pull theirs. Finally, we're going to talk about business funding sequences, and I'm going to give you a few different strategies that should come in handy. Now, a business funding sequence or funding rounds refers to the sequential stages a company goes through as it raises capital to grow and scale, typically starting with initial funding and progressing through various rounds. In other words, I'm saying that if we're applying for credit cards, in this instance, then we're going to apply for 3 credit cards strategically, or let's say 4, and then we're going to get 4 more, and then we're going to get 4 more. And I'm going to give you a strategy in order to do this properly and maximize. So you need to start strategizing where you're getting funding from and the order that you're going to do it. I have a video on the Lightstream loan. I suggest that you watch that video. The video is for a used car loan, but you actually get funds as if it's a personal loan. You can use this as a strategy. Let's say you were to get a Lightstream loan for $35,000 because Lightstream is known to lend out to people even if they have thin credit profiles. It takes about 15 to 45 days for that loan to actually report to your personal credit. That's a little while, right? If you deposit those funds into your business bank account, it's very likely that banks like Chase, PNC, Truist, First Citizens, Wells Fargo, I'm giving you all the examples. It's a great chance they will give you 75% of what you deposit as a credit line. You didn't have to have a high credit limit on your credit cards. This just made it more likely. So if you take $25,000 or 35 or the 40 and you deposit it into that business bank account, it is very likely they will give you a percentage of what you deposited. Now, let's say you hit Chase. They pull from Experian. That's your $25,000 card with Experian. Take those funds, put it at US Bank. $25,000 with US Bank, that's TransUnion. Then you hit Truist. $25,000, that's Truist. All right. Let's say that you did this with 6 different banks and you did it before the loan reported. You can get access to $150,000. Once the Lightstream loan is reported, for most banks, because you just opened a brand new account, they're not likely to approve you for any credit cards for at least 90 days. But that's one round of business funding. You can then pay off a Lightstream loan if you want. I mean, if we're talking about credit profiles, then paying it off won't really help your credit score per se, but you could use the same funds to slowly pay it back and collect on-time payments. Then you could use those same funds with maybe, let's say, funds from the credit cards if you decide to liquidate or do anything else, and then do the same thing for another round with 4 different banks in 90 days. You can keep reusing this exact same strategy. And this doesn't only work for people that have a thin credit profile. It actually works for people that have really good credit too, or a thick credit profile. This would just be more likely that you could get even higher limits. And if you don't want to get a personal loan, I completely understand that. I'm not suggesting that you just have to do that. I'm just saying that's an option. You can do this with $25,000 of your own money. You don't have to use a loan. You can do this, again, 6 times, get $25,000 between each card. That'll give you access to $150,000 in business funding. And that doesn't even include business lines of credit. Like I said, $150,000 is just the minimum. At the most, you could probably get up to probably 1 million, really, if you did this strategically. And the only thing you have to know is your credit profile, because again, your credit profile is going to be different. Everyone's is different. It's all unique, but you want to optimize your credit profile. You want to structure your business, and then you want to have funds that you can deposit like this. And again, we talked about the credit card stacking strategy. This would be the business funding sequence strategy that you can use in order to credit card stack properly. And again, you can rinse and repeat this process. You can also, in 90 days, go back to Lightstream and get another $30,000, $40,000 loan. And you can do this every 90 days up to $100,000. After that, they probably will ask you for a financial review because you've reached the maximum limit of exposure. But, that's just a really simple way that you can do this and get this funding in a sequence. And hopefully this strategy will help a lot of people. So in summary, let's wrap all of this up. A new business can acquire $150,000 or more in 0% interest rate funding for 6 to 18 months. And using credit card stacking can make this easier for a new business to receive working capital, as they don't have financial documentation, tax returns, or anything like that, which is the reason why you get several credit cards or several business lines of credit or funding from different places, so it can equate to one large line. Most lenders only check one of the 3 major credit bureaus, which enables you to get multiple approvals across all 3 bureaus, potentially getting you between 8 to 12, 10 cards. But you need to have the right credit profile to be approved using this method, and it does require a PG. But if you want to make sure that you get high limit approvals, you need to either 1, have a very thick credit profile, or 2, you can use the business funding sequence that we talked about by leveraging, let's say, like a personal loan with something like Lightstream, putting the money into accounts, getting your funding from each of these banks, and then moving on to the next round. And again, you can do this every 90 days or so. All right, I want to thank you guys so much for watching this video. Once again, if you're new to this channel, please like and subscribe. I really would appreciate it. Again, I would like to welcome you. Again, share this with anybody who you think may need this information. And if you have any additional questions, please leave those in the comments below. And you guys have a wonderful day.